Good morning from our global headquarters in New York. I'm Manus Cranny with Danny Berger. You're welcome to Bloomberg Brief. Let's set your agenda.
Countdown to NVIDIA. Investors await the chip maker's first quarter results after stocks hit yet another all-time high. Plus, retail earnings come from Target. TJX will get more insight on the consumer. And China hints at a 25% tariff on imported cars that could hit U.S. and EU car makers. Good morning, Manus.
Good morning, Danny. We're counting down. We've got 24 records in a row. We've given 1/10% back. Get ready for a $200 billion swing around on NVIDIA. Typically, and we'll talk more about this in just a moment, there's NVIDIA down 1/3 of 1% at the moment. But the skew is very much tilted towards a full bullish beat by NVIDIA. We'll talk about that in a moment. For the moment, we're giving back 1/10 of 1%. The measures of risk out there, Goldman Sachs say risk appetite is at the highest since 2021. What kind of paradigm are we shifting into? We'll ask Apollo Torsten Slok about his vision of the next paradigm. 10-year yields spiked a little bit higher on the back of the rise in British government bond yields as inflation in the UK came in a little bit higher than the market had anticipated. And that gave us quite an outsized reaction both in the pound and two-year government bond yields. Two-year government bond yields, as you can see, spiking higher at the very short end of the curve. That promise of a return to 2% inflation seems to be delayed. Sterling went bid. The bond market went up as well. Waller came out and talked about reassuring signals in price pressures. But again, it is about an extension of when those rate cuts may come in the United States of America. Sterling's at a 2-month high. Go on, Sterling. Danny, good morning.
We get some Goolsby comments today. We also get some FOMC minutes. But let's be honest, the risk event is NVIDIA. And the risk is this, is that the market is extremely one-sided going into these NVIDIA earnings. For example, Goldman Sachs' risk indicator, it shows the highest amount of risk appetite since 2021. Citi flows reflect that as well. Citi saying that the market is very one-sided. And yes, NVIDIA might come in really good. It might surprise the market as it tends to do. But it just goes to show if it doesn't, there's a big buildup that might be pain once the dam breaks. Yeah,
and if that dam breaks on the downside, by the way, they have raised their forward guidance in over 30% of their earnings call. They've beaten on sales estimate, and they've delivered earnings per share beats 80% of the time. So it's like a triple crown in rugby in terms of their capacity to deliver. Yes. But it could be a clearing event. I mean, that is the other side. You can look at this in a number of different ways. One, it could fill or kill in terms of sentiment, which is a wonderful phrase. But it can also be a clearing event within that Mag 7. But, of course, it depends what your view is for AI going forward.
Right. Well, the last NVIDIA earnings, the entirety of the S&P moved 2% higher after its earnings. I mean, that's equivalent of a CPI day. You can see why people talk about this as a macro event. But I feel like it's like Pavlov's dog. We hear that NVIDIA is going to earn, and we start to drool and buy up stocks.
We now know where Danny's retirement fund is majority placed.
Oh, man, I can't trade individual stocks. Or else, we might be talking about something different. Okay, let's bring in SocGen's Kokou Agbo-Bloua onto this conversation, Kokou, because, we're not talking about Fed minutes here. We're not talking about speech from a Fed governor. We are talking about an individual company's earnings. But how much today is riding on NVIDIA?
Well, I think it's an interesting situation because corporates, in our opinion, have developed a natural immunity against higher interest rates. And if you add greedflation in terms of their ability to raise prices, they've actually benefited from this environment of high inflation. When it comes to NVIDIA, one of the things that to think about is the S curve when you have a new technology that is being rolled out. So Copilot for Microsoft, for example, is allowing the company to raise prices quite meaningfully. And NVIDIA is obviously in a dominant position when it comes to semiconductor. And our opinion is that you can clearly have a clear-out event because the momentum is so strong. But if you take a step back and you look at the adoption rate of AI and how it's going to transform our daily lives, I think this is clearly the beginning of a pretty powerful cycle as opposed to the end of the beginning. So we are probably more optimistic on the ability of the company to deliver, but more importantly, the pricing power it will have going forward in maintaining margins and profitability.
It's very tempting. We'll talk to Torsten Slok in just a moment, what kind of productivity gain we're going to get, which plays very much to the macro economist view. But Danny and I started the show talking about positioning, sentiment, the skew. You look at Goldman's, you look at Citi, and we get this sense that we are at this very extended bullish scenario. Citi's positioning almost exclusively one-sided. You know, when the tilt in the boat goes so far to the right-hand side, it makes me nervous. But then I'm just naturally nervous about risk. What do those positionings and those skews say to you?
Well, this is an interesting point. Clearly, there's a huge positioning when you have a stock that outperforms so much, because investors follow a sort of Darwinian process of natural selection by the P&L of their position. So you have a clear event if you underperform, and then you get the new generation of people chasing performance. But when we look at equity risk premium for the S&P, for example, we don't see the market being as bullish or in an irrational exuberance type scenario, simply because earnings are also growing as fast as the market is going up. And I think this is a very important dynamic, because we are having an earnings inflation, so to speak, with companies benefiting from this pricing power, and operating and financial leverage are making earnings reach all-time high as well. So we are not in the camp of seeing this sort of performance of equity markets as a sign of investors' sort of excessive bullishness or excessive risk-taking. And last but not least, we've done some polling from investors, and the number one concern they have is uncertainty about the future. Recession risk.
Kokou, if I can just jump in here before we get to that uncertainty about the future point, I want to go back to the pricing power point. I understand the thesis of why AI companies like NVIDIA have pricing power. But when you look at a Target and a Walmart and a tit for tat lowering prices, trying to attract the consumer, you have, for example, Amazon talking about consumers not wanting to pay up as much. Can pricing power continue given the state of the income earning consumer right now?
I think it's important to realize that real wage growth is now positive. So wages are growing higher than nominal inflation or headline inflation, because there's a delayed effect, and headline inflation has essentially come down quite meaningfully. The second important point is excess savings. Clearly, they've reached $2.5 trillion at the peak is in 2021, and they have come down by 40–50%. But you still have consumer having jobs. We have a tight labor market. Wages are going up. Clearly, they're not, spending as much as they did before, but they are not in a sort of difficult position, which would have been the case had unemployment reached, 6, 7, 8%. So I think this is where we're seeing real GDP growth in the U.S. reaccelerating compared to the rest of the world.
Look, there's no doubt about it. This economy is strong. There's a bifurcation in this economy, as Danny says, between working families with food bills and gas bills and upper middle class, which is earning 5% on their CDs. And that's where the challenge of transmission mechanism is for the Fed. We interjected, and we would like to know in terms of the biggest concern. We have a poll, we've got a Morning Consult poll. It's around Biden and Trump and the event risk around the election. What is top of the agenda in terms of concern that could prick this bubble, this sort of meteoric rise, 24 records in a row in the equity market?
I think the key risk is the bond market. If you remember the Liz Truss mini-budget crisis, where essentially we had a situation where the government was looking to increase budget deficit by doing more fiscal stimulus at a time where inflation was still a problem. And here we have core inflation still being pretty sticky because of service price inflation that are depending on wage growth because of the labor intensity of services. So if we have a Trump scenario in November where we go for more deficits, more government spending at a time where the economy is at full employment, then you could see bond yields surge quite meaningfully, and that could create a massive expansion of the equity risk premium and causing equities to unravel.
Kokou, I even just think of where bonds are right now. The more volatility in them, especially when you have central banks like China backing out as holders of this bond market. More individuals are holding it. There are banking regulations which make it harder for banks to absorb losses in this bond market. In an environment like that, where you have this risk of, maybe a Liz Truss moment, of more volatility, where do bonds belong in a portfolio? Because so much of asset allocation is based on the idea that bonds are the staid, boring part of your portfolio. And time and time again, Kokou, we're starting to learn that perhaps that's not the case right now.
Absolutely. I think the equity bond correlation is the Achilles heel of multi-asset portfolio. And we're seeing that correlation being itself volatile and unreliable. And this is why there are alternatives like currency hedges or equity volatility and options as a way to diversify away from the dependence on bonds. But that being said, I think it's transitory. So we typically see the equity bond correlation be volatile in a short term, but medium to long term, it still holds. Because if the US were to enter into a major slowdown, and we expect cuts to start in March of 2025, the Fed has a put that is essentially reloaded. They have 500 basis points of cutting power to stabilize the economy. But the Achilles heel is clearly on inflation going too high, in which case they don't really have much choice than holding interest rates for higher for longer.
Okay, Kokou, thank you so much for being with us, Kokou Agbo-Bloua. We got through almost an entire section virtually unfettered. It was a thing of beauty. You managed to drag it in. Well done, Kokou Agbo-Bloua, there, our Societe Generale.
It's a good accomplishment, I think.
I think it's a pretty good accomplishment at 5:10 after a lot of Fed speak. Let's get to the other stories trending on your Bloomberg terminal this morning. This is what we got for you. Citi was fined $79 million by the UK regulators for failures in trading systems and controls. London staffers' fat finger trade caused a flash crash in European stocks. That was in 2022. Citigroup did not dispute the regulators' findings and agreed to settle the claim.
BHP has until noon Eastern today to make an offer for its rival, Anglo-American, or walk away. Anglo has already rejected 2 offers from BHP. The last one was worth $43 billion. Instead, Anglo unveiled its own plans for a radical restructuring.
Israel has recalled its ambassadors to Ireland and Norway after they announced they would recognize a Palestinian state. The coordinated move, which was soon followed by Spain, underscores how the war in Gaza is focusing the global attention on the issue of statehood for the Palestinians and hurting Israel's relations with other nations.
Now, coming up, the economy is looking strong at least for several more quarters. That's the view, according to Apollo's Torsten Slok. We're going to be catching up with him later this hour.
China signals it's ready to unleash 25% tariff on US and European cars. The details on the latest trade tensions next. Context matters on Bloomberg. This is Bloomberg Brief. I'm Manish Rennie alongside Danny Berger in New York. We have the latest Bloomberg Morning Consult poll, and it finds that half the swing state voters are worried about violence around the November election. Anne-Marie Hordern is with us. Anne-Marie, we can come back to the main concern about violence, misinformation and foreign interference. It's there. It's a definite subplot, and I think it's on every newspaper. But as you stand back now, we've had a series of these polls. If you stand back, is there anything demonstrable? Is there a shift? Is Biden making up ground? Is Trump still materially ahead? What would you assess it as?
We do this poll every month, and what you could see in this latest one as compared to last month is that Biden is starting to make a little bit of a shift. One thing is clear. He's performing very well as opposed to some of the Sun Belt states where he did make a little bit of improvement, but he is performing very well in the blue wall, Michigan, Wisconsin, and Pennsylvania. And if you talk to anyone in the Biden camp or any sort of Democratic analyst looking at the election, he has to hold the blue wall in order to win in November. So for the Biden campaign, the fact that he's starting to pick up a little bit of momentum there, that is good. I'm looking at Michigan. It's 46-45, Biden to Trump. Wisconsin, 46-47, so very, very tight. And Pennsylvania, 46-48. So he still has some work to do there, but it is so, so close. And I think when you take a step back and you look at where we are now and the months leading up to the election, these 7 swing states are absolutely key. And specifically for the Biden camp, it's that blue wall that is absolutely critical to win in order to beat Donald Trump.
Is there anything that Biden's done differently or anything clear that's helped him advance in some of these blue wall states?
I think what you could see from the Biden campaign is that where Joe Biden is going. I mean, he was just in Atlanta, then he immediately went to Detroit. He is spending a lot of time. He was just talking about AI and chips and Microsoft, which actually when we ask our respondents in the open-ended questions, anything that you've seen in the news about any of these candidates, I looked through some of them and a lot of individuals said, well, he was just in Racine in Wisconsin talking about this stuff. So he's spending time and money in these states, and that's obvious. The other thing, of course, that it's happening is the Biden campaign is trying to show a split screen between what the president is doing and where the former president is. And the former president at the moment has been held up in court in a New York trial. And that's the split screen they are trying to show to the American people. And at that same time, we do see some of our open-ended comments for Trump. More than 1,000 of these respondents were talking about that hush money trial.
Well, it's interesting, that imagery. It's almost like a daily sort of media homage. If you look at any other network through the day, it's the pivotal piece in terms of what happened. There are other things going on in the world. We have two different stories. We've got tariffs, again, tariff escalation, potentially by Europe. And then we have student loans, more financing for student loans. Biden widens the student loan relief. What are the details? So what's the top line on that, Anne-Marie?
So what we've seen over the course of the past few years with this administration is they've wanted to do more to shore up definitely the youth vote and also to try to relieve some of that student loan debt. The Education Department has unveiled regulatory changes incrementally over the months. Today, the White House is coming out saying that more than 1 in 10 Americans with federal student loans have been approved for some additional debt relief. There's going to be a lot of criticism on the Biden administration from the other side of the aisle, saying that this is a levy they are pulling before the election to try to shore up that youth vote. And they're doing it once again. When you look at our polling and you ask who is actually better when it comes to student debt relief, actually sometimes it's mixed, because if you're on the Republican side and don't want to see that, they say that Trump will be better for that. But overall, this is something that is top of mind of that youth vote, which we know that Biden is trying to shore up and make sure they go out to the polls.
Anne-Marie, just quickly here, because we also need to cover the tariff portions of this. This potential threat of 25% car tariffs from China on the EU and the U.S. Presumably, this is just a Mercedes BMW story. Who does this actually hurt if this does come to fruition?
Exactly. I think this hurts the Germans, the German automakers, the most. And it's interesting because we heard from the German chairman, the BMW chairman recently, who talked about the fact that we don't want to shoot ourselves in the foot as the EU is undergoing this process of whether or not they are going to have higher tariffs when it comes to Chinese EV imports into the European Union. But that's, of course, what they're saying publicly. Why? Because they have a massive stake in getting into China. But I think what this shows is the direction of travel between Beijing, Washington, or maybe Beijing, Brussels, which is there's going to be a tit for tat.
Okay, Anne-Marie, thank you so much. Anne-Marie Horder, and they're covering a lot and happening in politics. Okay, Manus, we have some breaking news we need to go over. Oaktree says it has taken ownership of Inter Milan, the football club. Manus, to be clear, this isn't a takeover. They didn't buy Inter Milan. It is because the owner, Sunnings Holding, has defaulted on their debt, or rather they haven't paid their debt, and Oaktree, rather than giving them a new loan, a short-term loan, something like that, they have instead decided to take the keys. This is really remarkable when a lender decides to do that, especially for something as complicated as a football club.
I mean, these trophy assets, everything that we've talked about typically is, a bidding war between the Middle East, the Qataris and John Ratcliffe for Manchester United. But here we are, this is an Italian asset. And as you say, it is all about the credit that has already been extended to Inter Milan.
Yeah. And again, this is typically something rare that is done in private credit. They're creditors. They're not in the business of ownership. So significant that Oaktree have decided to take the keys. Okay. Coming up, we'll get you your top stories. It's your Bloomberg Brief. I'm Danny Berger alongside Manus Cranny in New York. Let's get you your front pages. Some look at what's happening around the world. So first up, Manus, I've got the New York Times. From the Donald Trump hush money trial, Donald Trump has declined to take the stand. Usually defendants don't take the stand, but this just now moves us quicker to next week, where we're going to get the closing arguments on this case, Manus.
Indeed. Next up, this is what we got for you. We have the Financial Times. Inflation. We started the show with this, a little bit hotter than we expected, 2.3%. The data shifts the expectations of when the Bank of England is going to be able to deliver. Bailey's sort of rhetoric has been undercut in many ways about the timing. By the way, their inflation is a lot closer to target, let's say, than the Fed's is. But it popped gilts, which popped bonds, which popped sterling. A lot of pops.
Yep, a lot of pops. Repercussions felt ahead of NVIDIA Day nonetheless.
Indeed.
Finally, on Bloomberg, this is the most read story today, Manus, that Barclays is telling staff in the U.S. specifically, get ready for 5 days in the office, specifically those dictated by FINRA rules, because FINRA has new rules for people working at home. And Barclays has said, the cost and change isn't enough to make us let you stay at home. Yeah, and it's about listing those home destinations. A lot of people are set up with the Bloomberg terminal on the desk, trading from home, or indeed delivering brokerage from home. A year ago, 20%, I mean, there was a couple of polls done, 20% were still happy to work from home. But we did a Harris poll a month ago, and I love this from the head of the poll. Our Peter Pan relationship with remote working is coming to an end. John Gerzema, Chief Executive of Harris Poll. Peter Pan's died. I think it's just an excuse, man. If Barclays wants to lay off staff, what a better way to do it than tell people to come in. Office. Well, JP Morgan brought a lot of their managing directors back last year. Look, we're going to talk to Torsten Slok from Apollo. We're going to see what paradigm shift he sees in the market. From our global headquarters in New York, I'm Danny Berger with Manus Cranny. Let's set your agenda. Count on to NVIDIA. Investors await the chipmaker's first quarter results after stocks hit yet another record high. Plus, retail earnings hit the tape from Target and TJX for more insight to the consumer. And China hints at a 25% tariff on imported cars. Could the majority hit the US and EU car makers? Danny, good morning. Counting down to NVIDIA. That's right. It is NVIDIA Day. Stocks a little bit weaker this morning, down about 0.1% after hitting a new record yesterday. The records keep coming and coming, but the risk event is NVIDIA. As we were talking about, Manus City calling it a one-sided market heading into this results. U.S. 10-year yields, those pop higher. Let's call it 3 basis points. We're at 4.43% this morning after UK inflation came in hotter than expected, 2.3%. The expectation was 2.1%. That's also backed us off of pricing for cuts by the BOE. We're pricing now less than 50 basis points of cuts. So there you get a rally in sterling. It was at a 2-month high, slightly backed off this level. Your cable is at 127. But man, it's going back to this idea of NVIDIA. We're talking to Kokou Agbo-Bloua of SocGen earlier this morning, who basically said, look, it's all's okay in the equity market. For one, these AI names have pricing power. And for two, earnings are keeping up with the exuberance. Yeah, and he talks about the S-curve. He talks about the ability of the likes of Microsoft to ask us for more money, to ask corporations for more money. And when it comes to the debate about positioning, we've got Goldman Sachs and we have a number of other houses talking about Citi, talking about excessively bullish positioning. But he was not of that opinion. As far as he was concerned, pricing power gives you profit power, and it was in syncopation. Yes, exactly. And that's his reason. Do not worry about where we are. But at the same time, Manus, I mean, valuations are high. But then I go back to the idea, if you were worried about valuations, probably for the past decade, you would have missed out on a large part of this rally. So there you go. NVIDIA today, I still think, like I said earlier, it's the Pavlovian dog. We hear they have earnings, we start to drool, and we start to buy. Yeah, well, we can get ready for an average move of 7 to 8% on that stock, which is the equivalent of $200 billion. But we'll be counting down to that on sentiment. Strangely enough, there was another facet to consider. It was the latest FOMC minutes. They will be later today, and in terms of what Fed officials have got to say. But let's take a listen to the Nobel laureate Paul Krugman, because he had a thing or two to say about where we were with rates.
On interest rates, I am fanatically confused. I mean, I actually think that you can make a really strong case either way. That we went through a long period of extremely low interest rates, which we thought were grounded in fundamentals, especially demography. And then now we've been going through a period of much higher interest rates with the economy remarkably robust in the face of those rates.
Let's see what Torsten Slok has got to say, Chief Economist over at Apollo. He is our guest this morning, joining us now. So, Krugman, on interest rates, he's fantastically confused. You're not. You're going still for no rate cuts this year. Torsten, good to see you this morning. But I want to get a sense from you. You talk about fiscal headwinds. The middle-class savings have popped. I mean, it's almost Churchillian. You know, you've never had it so good. So are we in such a halcyon moment in this economy? Are we moving towards a paradigm shift?
Well, this is a really important discussion. And I think what Krugman exactly is highlighting is the following, that we used to, for several years, basically 10 years since 2013, when Larry Summers first gave his speech, talk about secular stagnation. And the debate was that Demographics are significant headwinds. As a result of that, interest rates will quote unquote be low forever. But now instead we have some other forces that are pushing in the other direction, and that list of other forces is just relatively long compared to the secular stagnation argument. And those things are, of course, that we have deglobalization is inflationary, energy transition is inflationary, the more defense spending is inflationary, and you also have that some restrictions on immigration could potentially also be inflationary. And if you add the final two cyclical factors that are supporting inflation, namely easy financial conditions because of the Fed pivot in November, and because of tailwinds from fiscal policy, if you put all that up on the scale, you have that, yes, still we have these structural forces of secular stagnation in the background. There's just some new forces, namely deglobalization, energy transition, and also in particular defense spending, and even restrictions on immigration. Those things are new that are beginning to put some upward pressure on inflation. That's why the debate is around how much weight should we give to these two different lists of arguments.
And Torsten, you add that, which you so brilliantly have when you were one of the first to come out and everyone kind of followed along, that we might not get cuts so far in this year because you have things like people refinancing their homes. You have companies who also refinanced when rates were low, and it's made an economy less immune to hikes. So put all those together, Torsten, that doesn't sound like a world that's getting back to 2%, that could realistically even get back to 2% if the Fed just holds things where they are. Is that the moment we're at?
I think that is a very significant risk, Danny, because exactly as you're highlighting, a lot of firms prepared themselves for higher interest rates by terming out their debt during the pandemic. A lot of households, almost by definition in the US, have 30-year fixed mortgage rates, so that's about 95% of all mortgages. So they are also therefore less sensitive to interest rates going up. So those things just meant that the transmission mechanism of monetary policy, in other words, the time it takes, the so-called long and variable lags that the Fed members keep talking about, was maybe not only the 12, 18 months that it was in what they normally discuss and what the textbook would predict, maybe this just takes a lot longer time. And as that chart there you're showing is exactly highlighting, we have more than 50% of mortgages now that are below 4%. So the sensitivity is just not what it used to be. And that means that it needs more time before we achieve the goal. So exactly as you're saying, maybe the risk is that we just need rates higher for longer, which is exactly what we're pointing out.
Do we need something more severe than that? If you've got more than 50% with a mortgage below 4%, so the typical drivers of monetary policy are not as effective as they were. And you talk about even a huge swathe of America no longer having a mortgage. Therefore, if the transmission mechanism is not broken, it's just taking a lot longer to deliver. What else can the Fed do to slow the middle class? Because it is the middle class that's living off 5% CDs, their wealth is improving, the upper middle class. So what more must the Fed do? Is it just endure higher for longer than this market really anticipates, or something more severe?
Yeah, this is also really important, Manny. So exactly as you're saying, 40% of those who own a home, they do not have a mortgage. Think about that, 40%. That means there's a lot of people when home prices go up who don't have any debt obligations and are therefore benefiting directly when you see asset prices, in this case, home prices, continue to move higher. So what can the Fed do? Well, obviously, the textbook would say, well, the Fed can just raise interest rates more. But there's a number of unfortunate issues around doing that. Namely, if the Fed, after now, have talked about that the next move in rates will be lower, and they still, as we stand here today, have the prediction that we will see 3 cuts this year. Well, if that's the case, well, then it's really difficult to come out and say, well, we were wrong, we'll not get 3 cuts, maybe we need more hikes. So that's why, from a credibility perspective, it's just really difficult for the Fed to go and turn around 180 degrees and talk about rate hikes. So that's why I think that there will probably be a strong preference for saying, you know what, we will probably just keep interest rates higher for longer and let time do its work so that we ultimately get the result that we need. And that's why I still think that the market is wrong, anticipating that we'll get rate cuts this year. I still think that it's going to take a lot more time, because also firms have just been through a period where they had much more freedom to set their prices at whatever level they thought was the right one. And that's why the risk is anchoring those expectations is probably going to take more time than what many people expect.
Torsten, I mean, one could look at some of the data and make the argument for cuts. Not saying it's right, but you could, for example, you could look at CPI slowing down. You could look at some of these companies saying that the consumer is weak. You could look at retail sales slowing down. But obviously, Torsten, part of the problem of that is that doesn't necessarily capture what you're talking about. People who own homes, the wealthiest of the wealthiest, who can still spend and can still buy assets. The data, though, Torsten, was built in a bygone era where the consumer, where the economy was a monolith. Are we making monetary policy and trading off of data that's no longer relevant and fit for 2024?
It's very correct, and exactly I agree with what you're saying, that the issue really here is that we have a bifurcated economy, and we're just not used to that in financial markets. And a bifurcated economy means that it is some consumers, namely those with most debt, that are hit by interest rates going up. It's some firms, namely those with most debt, enterprise software, tech, growth, venture capital, because they don't have any earnings, they don't have any revenue, no cash flows. And if that's the case, of course, they will be more vulnerable to interest rates going up. Likewise, in commercial real estate, it's those skyscrapers, office, also multifamily that has the highest sensitivity to interest rates are those that are most levered. So we need to change our mindset in markets to exactly focusing on those balance sheets for consumers, firms, commercial real estate, where we have most debt. That's why high levels of debt is, of course, going to be more sensitive to interest rates going up. And that's what creates this bifurcated economy that exactly is creating these challenges where some balance sheets for consumers, some balance sheets for firms are experiencing distress as a result of Fed hikes, whereas others are actually doing just fine.
Torsten, when it comes to macro policy, today's actually a singular item. It is NVIDIA. That is a sentiment defining moment. Danny and I have been touching on this with guests through the morning. So NVIDIA will come. It'll be a clearing moment. It'll either be the catharsis or crucifixion on sentiment. But I want to get a sense from you as an economist. I went back to the year 2000, to Boston, to Greenspan, and this is what he said. Since 1995, output per hour in the non-financial corporate sector has increased at an average annual rate of 3.5%, nearly double the average pace of the preceding quarter of a century. You talk about the new inflationary forces of defense, of immigration, of louche financial conditions. However, my question to you as an economist, are we facing a Greenspan-esque paradigm shift moment in terms of what AI will do for productivity? That was a heck of a jump in those 5 years from 1995 to the year 2000. What thought have you given to this?
Yeah, this is really important because if we do get that jump in productivity, then we will get much more downward pressure on inflation. This is really crucial for the Fed, and therefore the parallels and the discussions of to what degree is this the same as the late 1990s is really, really important. And the ultimate question that we really all need to think about, which is so hard, is that the internet that came around in force in the 1990s, is that more important and has a bigger positive effect on the economy than AI? Or vice versa, is AI going to have an even more revolutionary and more positive impact on the economy than the internet had in the 1990s? Or in economics language, is the productivity gains of the internet, are they going to be smaller than the productivity gains from AI? My opinion is that AI is not going to deliver the same productivity gains that we got from the internet in the 1990s, simply because the internet was spreading information. AI is to some degree doing the same, but it's just not the same tailwind from a macro perspective. And that's exactly why in this discussion about inflation and squaring our circle in our conversation here, you have the challenge that we may not get that huge positive effect where inflation is getting significant downward pressure from AI, the same way that the internet was in the 1990s.
Torsten, I just want to linger on that because that is quite contrarian. It's even contrarian to company after company that we've heard of that have said part of the reason we are spending now is to spend on AI in order to get our costs in check, that will ultimately help us. Do you think that there are a lot of corporates out there, as well as you're saying some of the economic views of productivity of AI that are squarely misplaced at this moment?
I actually do, because just think about what's been going on in markets here more recently. Last year, it was all about the Magnificent Seven. All 7 companies traded in a very highly correlated way. They were going up, all of them at the most of the time, because the story was they will all be benefiting. AI will do wonders everywhere for all companies and almost to the same degree. But think about what has happened in the last few months. Maybe it did matter how many cars Tesla was selling. Maybe it did matter how many iPhones Apple was selling in China. And that's, of course, the dramatic difference you've seen in performance inside the Magnificent Seven. Some of the companies are down 30, 40%. Some of them, including NVIDIA, are still up. So that's why if those that are still left standing with a bullish outlook, namely NVIDIA, Meta, several of the others at the high end of the meaning high-end performance of the Magnificent Seven, if they do not deliver today, it may be the final crack in the AI story that maybe this was not just that everything will be benefiting. Maybe it was important that we did our homework in public credit, in private credit, in public equity, in private equity, because we need now to figure out which companies is it actually that will be benefiting from AI. And that's a very different discussion relative to just saying, oh, all companies will be benefiting the way that things were trading last year.
Yeah. And again, to your point, Torsten, speaks to the mispricing of a lot of things, if that is the case. Torsten, so brilliant as always. We always appreciate your time. Torsten Slok of Apollo. Okay, coming up, we're going to get back to the nitty-gritty of NVIDIA, a possible make-or-break moment, as Torsten was just talking about. That's to come on Bloomberg Brief. It's your Bloomberg Brief, Danny Berger and Manus Cranny in New York. So, Manus, we're going to get more retail earnings coming in. Both Target and TJX report before the bell. Let's get over to our reporter, Bloomberg's Dasha Afanasieva, on this. So, Dasha, look, we've already had some retailers. We've had a lot of retailers. And this theme that we're continuing to hear about is prices being cut. You have issues for both Walmart and Target. When it comes to something like TJ Maxx, is what's good for a discount retailer good for the rest of the consumer?
At the moment, it definitely seems like that's the case. Target is slashing prices on 5,000 of its products. And if you look at TJ Maxx, it's actually doing better than the rest of the retail sector. I mean, with sales expected to rise 3.4% in the quarter, you'd almost be forgiven for believing in the future of bricks and mortar retail and to think things are sound in that sense. Indeed, Target's Chief Executive Brian Cornell emphasizes that 2/3 to 3/4 of American shopping is still done in stores. So in that sense, the focus of the physical retail model is still alive and well. But Target is still expected to decline in terms of top-line sales today. And that's, they'll blame it on post-COVID normalization, and that is really a factor. But it's also the strength of the consumer and that shoppers are stretched.
And with that in mind, of course, yesterday we saw these 5,000 basic household items being cut by Target. Just last week, Walmart, I think the equivalent, I need to double check, is somewhere up around 7,000. All everyday items at Walmart are being cut. Now, Danny and I were debating this morning as to whether this was a reach for market share. In that battle for the lower-end consumer who is under pressure from higher rates. We just had a conversation with Torsten Slok. Or is it something new in regards to the end of greedflation?
I think it's the first option, because those consumers are really stretched. And we've seen numerous consumer goods companies like Pepsi, Nestle talk about that lower end that's really struggling from a reduction in government stimulus, from having to restart paying back student loans, from really high inflation, really high interest rates. So I think that companies are now competing for that consumer, and they know that it's a promotional environment. And as you touched upon, sort of the danger is, of course, that you lose a lot of margin, but they've kind of made the bet that maintaining market share is more important. And I guess in Target's case, I think they've already cut back costs in order to protect some of that margin. So they're sort of towing that line. I think also if we just mention Macy's and Lowe's yesterday, they actually beat estimates. So maybe it's too soon to write off the US consumer just yet.
No, we won't kill off the hedonism of the US consumer. They're certainly spending on credit cards. And I think, as Danny, we were just chatting this morning about delinquencies as well, weren't we, in terms of those credit cards? Yeah, exactly. Delinquencies are high, but as Bank of America says, it's only one piece of the debt picture. So if you look elsewhere, it's maybe not as bad. Okay, Dasha, thank you so much. Let's see what the numbers are when they come down. Dasha Afanasieva on the retailers. Coming up, we're going to talk Tesla. The shares are getting a little bit of a bite taken out of them this morning, losing ground in Europe. Context matters. Good morning from New York on Bloomberg. You're watching Bloomberg Brief. I'm Danny Berger alongside Manus Cranny in New York. Let's get you set up for your trading day on this Wednesday. We're going to get some economic data. U.S. existing home sales hit at 10 a.m. And then the Fed's latest meeting minutes will be released at 2 p.m.
All of that leads up to the only event we care about. It's NVIDIA's first quarter earnings. Manus, those come after the market close.
Yep, we'll talk about those in a little bit more detail. Some stocks to watch. You got at Tesla. European sales falling to a 15-month low. That's at the start of the quarter. The registration dropped by 2.3%. Urban Outfitters up 7.3%, extending their post-earnings gains for the first quarter sales beat. And Anthropologie and Free People's Brands driving the momentum there. Lululemon Athletic is down 4.25%. The Chief Product Officer, Sun Chow, departs the company, announcing that Chow would not be replaced. Look, the main event of the day is NVIDIA. We're counting down to that. We're expecting huge volatility. I think, Danny, a movement of 7 to 8% potentially around the stock. Let's get to Matt Bloxham in terms of what we're expecting on the numbers from Bloomberg Intelligence. Matt, good morning.
Hi. Yeah, I mean, really two numbers to focus on. There's the quarter that they're reporting. We're looking for $25 billion or so of revenue. They guided to $24 billion. The streets are already closer to $25 billion. And then it's about the guidance for their Q2, the forward quarter on revenue. And the streets looking for something approaching $27 billion. So I think they're the figures that the market's going to focus on, particularly that forward guide, something around $27 billion of revenue for Q2. And I think attached to that, then it will be then really focusing in on the CEO's commentary about the longer term demand trend. Are they seeing healthy demand for AI chips? Are they seeing that demand diversify away from the big hyperscalers like Google, Amazon, Microsoft, towards kind of more enterprise and government customers? And they announced a tie-up with Dell earlier this week. It's really important to get that diversification of demand to sustain that really strong revenue growth into the future. And ultimately, this is a growth stock, so they need to continue to sustain that revenue growth, for the next few years.
Matt, we appreciate it. Matt Bloxham of Bloomberg Intelligence. A lot is writing on this, Manus. We've talked about this, but just to linger over what Torsten Slok said, because I think this is fascinating, this idea that everything has been trading in a really correlated way. But that cannot last because AI doesn't benefit everyone in the same degree. No. So much is riding on NVIDIA's earnings, in part because of that everyone wins in this environment. It really can't continue.
I think, when we asked him, is AI going to be as what, if we look at the productivity gains of the late 90s, and I think this is interesting, Torsten sort of said the debate as to whether AI would deliver the outsized productivity gains that you had from the 1990s, and he's doubtful. He's not of that mind that you're going to get the same tailwind. When the internet happened and exploded across the world, that was an explosion of dissemination of information. This is something very, very different. But as he said, this could be the final crack, or the beginning of a major crack in Mag 7. So that's the scale of what NVIDIA can do for sentiment.
And also what NVIDIA can do for sentiment is the last time they reported earnings, the S&P gained 2%. That's the type of big gain you see something with like a CPI, for example, Manus. So no wonder everyone talks about this as a macro event because it has the same magnitude as impact as macro events.
Absolutely. I mean, the scale of movement, we're expecting potentially a 7 to 8% swing. So you're looking at $200 billion of a move. Dan will be on air for that. On surveillance.
Can't wait. Surveillance is ahead.
We'll tell you what happened tomorrow morning.